Our next keynote speaker is someone who pretty much everyone in this room, I'm sure, knows. He, in many ways, gave birth to the marketplace lending industry when he started Lending Club back in 2007. He's the first person ever to guide or to grow two different marketplace lending companies to scale. So without any further ado, please join me in welcoming Renaud Laplanche, CEO and co-founder of Upgrade. And to talk with him, we have Alex Rampell from Andreessen Horowitz. Gentlemen. Thanks, Renaud. Thanks.
Great, it's great to be here. So I thought we'd talk about this concept of bundling and unbundling to kind of get things started. And I guess, is my clicker working here? I think everybody's seen this slide before. It's a great one. I saw this a few years ago, and there were probably only maybe 25 logos on it. Now it seems like there are a few hundred. And as a venture capital investor, a lot of what I think about is unbundling the bank makes sense because you're kind of taking each one of these functions, maybe doing it better. But in some cases, banks don't make money on each incremental widget that they sell. So if you have a $100 checking account and a debit card and free ATM withdrawals, like the bank's not making money on you. They're waiting for year 7 where you get that mortgage. And then they say, okay, now we're going to make money. Now all those 7 years are finally profitable. So as a venture investor, I love this idea of unbundling, but sometimes it also makes me nervous because you're relying on that year 7, we're finally going to make money on that customer, we're going to make it up in volume at that point in time. How do you think about this? And if you think about where banks make money and where fintech companies make money, how do you think about bundling and unbundling?
Yeah, so I think it's useful to start with sort of market size, just to get a sort of general idea of sort of where banks make money. Right. And so if you look at the 4 main businesses of US commercial banks, so you have stock brokerage and wealth management, advisory businesses that are each slightly under $200 billion in sort of US revenue annually. Then you get into payments, that's closer to $300 billion annually. And then lending is actually where sort of most of the revenue are. So you've got $1.2 trillion just in interest income. And then you have sort of all the fees attached to it. And so if you actually think of sort of credit cards, also in the credit card interchange, that's a good portion of that $300 billion in payments. That's really enabling credit. So I think credit and lending in general is really sort of one of the main revenue driver, or by far the largest revenue driver. But interestingly, most of the sort of fintech penetration, defined as sort of percentage of customers who have used a fintech product or say that they're willing to use a fintech product in the future, most of that penetration has happened in payments, right? So you get 50% current penetration, 65% so future use, according to a Ernst & Young survey about fintech usage that they put out every 2 years, while credit is only sitting at 10% right now. So there's no necessarily reluctance to use so fintech products for credit, and so twice as much the consumers, 20% say they are willing to use credit products for fintech startups. But so far there's been a really big disparity in sort of penetration in different areas of banking.
Why do you think that is?
So I think there are a few possible reasons. I mean, one is payments, I think, is mostly a sort of user experience and engineering problem, right? It's about sort of removing frictions, it's about being available when you need it, and it's clearly an area that sort of entrepreneurs and engineers and innovators are really good at, and problems that they're good at solving, whether it's in Silicon Valley or where innovation happens all around the world. Including in Asia, primarily on mobile payments. But I think what's interesting is credit is also to some extent an engineering and sort of user experience issues, but it also requires sort of loan underwriting, loan servicing. It requires a higher level of compliance and regulatory awareness, things that aren't necessarily, skills that aren't necessarily so there's a strength of innovators and entrepreneurs. And all the sort of regulatory framework sometimes slows down innovation. So I think all these reasons have caused sort of payments to really sort of gain steam earlier. The other issue with credit is it's a lot more capital intensive than payments.
Right.
And that's one of the issues that marketplace lending has sort of helped resolve or at least mitigate,
right, is
to sort of outsource the balance sheet and make it more capital light. And which really sort of helps get started, but then you don't scale as fast because if you outsource the balance sheet, you need to also outsource it to investors who are going to rely on track record, and it takes time to build and maintain a track record.
Yep. Well, one of the things as well is kind of where do you start? So every fintech company that pitches me says, I want to own the customer relationship. And maybe I won't do 40 things like Wells Fargo does, but I want to do 10. And arguably the most important thing is if you own the direct deposit of payroll into a checking account. But this kind of goes back to this, you might do that, you might lose money on that customer for 5 years, and then in year 6, maybe you make money because you originate some kind of loan for them. There's a lot of net interest margin from that particular customer, but you don't have a lending product yet. You just have a basic checking shell, or you have a debit card product. So how do you think about, this is where the bundling conversation is so interesting. So on the one hand, you can make a very strong argument of start off with lending because, from the venture capital perspective, that could be cash flow positive from day one. Like if you originate a loan, if you go sell that loan, then you've paid for your customer acquisition cost right then and there, and then you can try to get that person to use a checking account, to get them to use a debit card, or you could start the other way around and say, I'm going to give somebody a basic checking account or a basic debit card, get them to direct deposit their payroll, and then eventually bundle in other things over time. So how do you think about the right bundle?
Yeah, so I think we've seen some really interesting strategies over the last several years in terms of rebundling some of these services together. So on this slide, what we call the monetized products being on the right. So these products we talked about earlier, so stock brokerage, investment advisory, payments, and credit. And some of the free products on the left, and the free products are sometimes used as an entry point, so to gain sort of mass adoption and monetize these products later, or they can be used as a retention tool or as a way to gain more sort of data, more insights into our customers' lives. And so the top 3 rows would be sort of credit companies that really started with credit products and then slowly expanded to the left and offered either sort of more monetized product in terms of payments is really the logical extension, or sort of ways to again gain more insights or help sometimes shape the behavior of our customers with financial education and by giving our customers more data. But I think some of the strategies I find the most interesting are those who start with a free product. So like Dave, Chime, Earnin, they start with a deposit account and both find ways to monetize the account. As, for example, charging like $1 or $2 a month as a subscription model by making the account more useful by doing reporting and alerts if you're spending too much and how far are you for the next paycheck. Or using really the deposit account as a way to gain sort of mass market adoption and then sort of cross-sell sort of either payments product with sort of Chime offering a sort of debit card and earning the interchange on a debit card, or Dave offering a sort of $75 sort of advance on your next paycheck and monetizing that advance.
So what's been your approach for Upgrade?
Yeah, so I think Upgrade has really sort of taken the approach of like starting with credit and sort of expanding in a couple of ways. So one expansion we performed very early on is what we call credit health. So credit health is a series of credit monitoring, credit alert, and credit education products and features, including sort of proprietary content that we developed that started with text-based content, and then we started doing video. So we have this video series with 1 minute video that you can sort of watch on your way to work, and each 1 minute video addresses a specific area of your credit or your financial life. And we have a sort of credit simulator that really helps consumers sort of better understand the impact of financial decisions that they might be making, the impact that would have on their credit score, but not just their score, really on their credit standing, on their credit health. And being able to simulate that is really important because a lot of these, the way the credit score works is pretty opaque and really not necessarily intuitive and very counterintuitive sometimes. And so we make this product available to both to our existing customers and to sort of anybody who declined for long. And so that's a case of sort of expanding from a monetized product, which is credit or personal loans, into something that's free for our customers. So that's a cost to us. But the way we get paid back for it is by helping our customers make better decisions and get to a better place. And that's really the meaning of Upgrade as a brand. It's really helping our customers get to a better place. And so what we've seen, so now we've been running personal loans together with credit health for close to 2 years. And what we've seen is almost perfect correlation between how much our users are using credit health and how they perform on their loans. So that this chart shows for each bucket of risk, near prime, prime, and prime plus, is the sort of delinquency rate as a function of the number of interaction with Credit Simulator. And you see that the more our customers use the Credit Simulator, the more engaged they are in trying to improve their credit, the better they're going to perform on their loan.
And I guess the nice thing there is that rather than just judging the customers as they are, you can change their behavior. So you can actually change their credit score, which is good for you and good for them.
Exactly. And so now the second way we're expanding, and if you remember that chart, so we started with credit and then we're adding payment. So we're launching a Upgrade card. And so one way to think of the Upgrade card is just this idea of bundling a credit product with a payment device. But I think it's what's interesting here is to sort of take a step back and think about sort of why we're doing this. So, I mean, the first thing to keep in mind is credit cards are sort of bad consumer products, right? They have very high rates. They have a lot of fees that aren't necessarily very, very predictable. And I think the worst feature, and sometimes the most misunderstood feature about credit cards is the monthly minimum payment, right? So if you're making only the monthly minimum payment, it's going to take you 25 years to pay off the balance on your card, and you'll end up paying back 3 times what you initially spent. So the way the cards work are sort of designed to really keep people in debt or keep the balance as high as possible. As long as you're current on your balance, the incentive of the bank and the credit card issuer is really to keep that balance as high as possible for as long as possible. So with the Upgrade card, we really took the problem very differently and try to address it and try to do what's good for the consumer. And what's good for the consumer is actually to pay down the balance as quickly as possible so that interest will run for a shorter period of time. And so looking at what we've done so far over the last sort of 12 years, since the beginning of marketplace lending, I think the 2 companies I started, Lending Club and Upgrade, together probably refinanced $50 billion in sort of credit card receivables. So it's not negligible, right? There's about $1 trillion in credit card receivables. We refinance 5% of it. The marketplace lending industry in general that has grown over time probably did another so 50 billion. So it's 100 billion. But yet, over the last 12 years, credit card balances outstanding have grown by 200 billion. So despite of 100 billion in refinancing, it still has grown by 200 billion. So it went from 840 billion to 1.04 trillion. So despite of all the refinancing happening, we're not solving the problem. We're not even making a dent into it. So I think we said, okay, let's just move upstream. Instead of refinancing credit cards, let's give consumers a card that will have all the benefits of a personal loans and will essentially replace traditional credit cards. So the upgrade card really combines this payment device. So you can use your card at every point of sale. It's a physical card as well as a tokenized card that you can that enables mobile payments. But then when you use the credit function of the card, the balance at the end of the month turns into an installment plan that you pay down over 12, 24, 36 months. It's the same low rate as a personal loan. It's a fixed rate, so you don't get surprised with the rate on your existing balance going up. And it pays down every month. It forces people into the discipline of really sort of getting out of debt over time.
That's great. So just in the last couple minutes here, maybe we can go a little bit back to the future and talk about marketplace lending. And it's very cool for me to be here with you because I think of you as being the godfather or the father or the grandfather, all of the above of this entire industry. So,
I feel old now.
Well, because there are two ways that banks make money. They make money on fees or net interest margin. And if you think back of how banks worked 200 years ago, they had to be local because you'd make a deposit locally and then you'd go borrow money locally. And now banks, the world is flat, as Thomas Friedman says. So you might have a bank in Iowa that has too many deposits. You might have a bank in Ohio that has, great opportunities for lending, or too many loans, really, and not enough deposits. And effectively now marketplace lending versus 12 years ago, it might have been this is what's going to kill the banks. Now this actually can help banks. Maybe you can talk about that a little bit because we were talking about this earlier.
Yeah, and it's really something I've been the most surprised with over the last 12 years is, and pleasantly surprised, is how we managed to work with banks. I think the first generation of fintech companies was very sort of anti-bank
right.
and wanting to replace the banks. And I think we've discovered that we can really establish win-win partnerships and play to each other's strength with the banks. And I think the first sort of series of partnerships were very, very functional, very transactional. And it's something we pioneered at Lending Club was really sort of selling loans to banks, right? And realizing that fintech companies have a low cost of operations, banks have a low cost of capital, and if you put the two together and you let the sort of fintech company originate and service loans and the bank provide the capital, you can really drive down the cost of credit and make credit more affordable for consumers. But I think we are now ready for a new type of partnership that involves things that are sort of will be more useful to consumers and closer to the core business of both fintech firms and banks, where you can start sharing user experience, customer life cycle, even brand, and have more and more sort of co-branded programs. I think a good example of that was banks and Zelle, so the payment system put together by banks. And because it came from a bank consortium, I think banks were more comfortable using the Zelle brand. But I think that we're going to get there with sort of other fintech brands and really design together, I think, the best possible sort of life cycle for a customer, where a customer might get their sort of deposits and their mortgage from the bank, but they might get their sort of unsecured loan and card from the fintech firm. And we can sort of also share data, share the experience, and craft the best possible sort of, overall experience and value for consumers.
Yeah, and where that fintech firm as well might be getting their capital from the bank.
Exactly.
Yeah.
Yep.
All right. I think we're out of time.
I think so.
But thank you very much, everyone.
All right, thank you.